Hello friends, we are going through the another module, that is 2.8, that is stock market operations. This module concentrates with the stock market and its functions, stockbrokers and client acquisition, then responsibilities of a stockbroker and trading system in capital market, and another one is sequence of trade execution, online trading. We can see the transactions in the secondary market pass through three distinct phases: trading, clearing, and settlement. While the stock exchanges provide the platform for trading, the clearing corporation determines the funds and securities obligations of the trading members and ensures that the trade is settled through the exchange of obligations. The clearing banks and the depositories provide the necessary interface between the custodians or clearing members for settlement of funds and securities obligations of trading members. Then we can see the stocks and shares are collectively referred to as equities or securities and represent an ownership stake in the company. Stock markets are the place where buyers and sellers exchange these securities. A stock market may be physical or entirely virtual. The Bombay Stock Exchange or BSE is a physically located on Dalal Street in Mumbai city. Trading was traditionally done in person, but the option to buy or sell more stocks electronically was added later. Earlier, trading was initially done by telephone, but is now primarily done by computer. The process of exchange is generally for buyers to name a price they are willing to pay for a particular stock and for sellers to name their selling price. In physical markets, brokers and specialists match buyers and sellers, but this can be done entirely by the computer in virtual markets. Then we can see what are the functions of a stock market. The first function is providing liquidity and marketability to existing securities. Stock exchange provides a ready and continuous market for buying and selling of securities. It provides a platform where shares can be sold and bought by buyers and sellers. Another function is pricing of securities. Based on the forces of demand and supply, stock exchange helps in putting the value on the securities which provide instant data to both buyers and sellers and thus helps in the pricing of securities. Another one is safety of transaction. All participants associated with the stock exchange are well regulated and are required to work within the legal framework given by the regulator. Such a system ensures the safety of transaction. In India, all trading is regulated by SEBI. The fourth one function is contributions to economic growth. People get a chance to buy and sell their shares, letting them invest money. Stock exchange provides a platform by which savings get channelized into the most productive investment proposals, which leads to capital formation and economic growth. Then next one is spreading of equity culture. Stock exchanges have extensive information on the listed companies which is further available to the public. This data helps in educating public about investments in securities which leads to spreading of wider ownership of shares. Another one is providing scope for speculation. Securities when purchased solely with a view of gaining profit through price movement to a target is called speculation. Stock exchange provide scope within the provisions of law for speculating in a restricted and controlled manner. Now we can see what are share brokers and their client acquisition process. Firstly, we need to identify brokers and authorized persons. A broker is a member of a recognized stock exchange who is registered with SEBI and permitted to trade on the screen-based trading system of stock exchanges. An authorized person or AP is an agent of the broker. They are previously referred to as sub-brokers and is registered with the respective stock exchanges. Both brokers and APs can be individuals, partnership firms, private or public limited companies, including subsidiaries of banks and financial institutions. Registered members of the stock exchange are required to prominently display their membership details at their front offices to enable investors to verify that they are dealing with a registered entity. Trades have to be routed only through the trading terminals of registered members of an exchange to be accepted and executed by the system. Broker members of exchange can complete transaction on the exchange only electronically. Brokers can trade on their own account too, using their own funds. Such transactions are called proprietary trades. SEBI registrations to a broker is granted based on factors such as the broker's eligibility to be a member of a stock exchange, availability of adequate office space, equipment and manpower to effectively carry out his activities, then past experience in securities trading. SEBI ensures the capital adequacy of brokers by requiring them to deposit a base minimum capital with the stock exchange and limiting their gross exposures to a multiple of their base capital. Brokers receive a commission for their service, which is known as brokerage. Maximum brokerage chargeable is fixed by individual stock exchange. Now we can see what are the responsibilities of a broker. The first responsibility is to maintain record of client transactions and operate separate trading account for clients and for proprietary trades. Then maintain funds of clients in a separate account. Then issue of contract note to clients within 24 hours of the execution of the order. Then collect funds or securities from client prior to the paying day in the settlement cycle of the relevant exchange and make delivery or payment to the client within 24 hours of payout from the stock exchange. Then appoint compliance officer who will be responsible for monitoring compliance with the rules and regulations applicable to the functions of a broker and for redressal of investors' grievance. Now we can see what are the procedures related with the client acquisition. A trading member has to complete the KYC formalities and in-person verification IPV before opening client accounts. The account opening form contains a KYC form that captures basic details about the investors such as their personal details, name, gender, marital status, permanent account number and residential status and UID number along with the proof of identity. Address details need to be collected, postal address, phone number, email, other permanent address along with the proof of address. Then other details need to furnish are income, occupation and net worth. Then detail of bank accounts and depository accounts are also collected. Then also a detail of action taken on the client by any regulatory authority in the last 3 years. Apart from the KYC, a trading member is also required to issue the following documents to the clients. The first document is document stating the rights and obligations of stockbroker and client for trading on exchange, including additional rights and obligation in case of internet or wireless technology based trading. Then uniform risk disclosure document. Then guidance note detailing do's and don'ts for trading on exchanges. Then index of documents giving details of various documents for client account opening process. Then a tariff sheet specifying various charges including brokerage payable by the client to avoid any disputes at a later date. The information on contract details of senior officials within the stockbroking firm and investor grievance cell in the stock exchange so that the client can approach them in case of any grievance. The trading member is required to formulate several policies and procedures for the information or benefits of the clients and issue them to the clients and also publish the same on its website. Details of such policies are as following. Inactive accounts policy covering definition of the term inactive accounts, the time period for declaring account as inactive, return of clients' assets, procedure and reactivation. Setting up of clients' exposure limits, then applicable brokerage rate, imposition of penalty, delayed payment charges by either party, specifying the rate and the period. Then right to sell client securities or close client's positions without giving notice to the client on account of non-payment of client's dues. Then shortage of obligations arising out of internal netting of trades. Another one is conditions under which a client may not be allowed to take further position or the broker may close the existing position of a client. Then temporarily suspending or closing a client's account on the client's request and deregistering a client. The trading member is also required to display a set of standard client registration documents and information pertaining to client's position. Then statements of accounts etc. and provide secured access to clients by way of user ID and password. Brokers are expected to diligently comply with the KYC norms and check all supporting documents. The uniform KYC norms notified by SEBI applies to stockbrokers too, apart from depository participants, mutual funds, portfolio managers and other securities market intermediaries. A unique client code or UCC has to be generated by the broker for each client. the UCC has to be submitted while placing orders or carrying out trades in the exchange. In order to ensure that the client does not delay or default in the completing the settlement obligations, brokers tend to seek payments for buy trades in advance and ask for securities to be kept in the pooled accounts with the brokerage firm. This may lead to malpractices where client funds and securities are used in lending or in proprietary trades. Several brokers offer a 3-in-1 account that securely link bank and demat accounts with the trading account of the client with the broker. Others operate these accounts on behalf of the client using a power of attorney. When clients sign account opening forms, they have to understand the specific arrangement the broker is proposing to ensure timely settlement of trade obligations. Now we can see what is a 3-in-1 account. The 3-in-1 account allows an investor to merge the savings bank, demat and trading accounts. If a bank provides a 3-in-1 account, the bank account and depository services are offered by the banks. The trading account is usually held through its subsidiary, which is a registered broking firm. If a broking firm offers a 3-in-1 account, the broking and depository services are offered by the broking firm, in some case through another DP. And the bank account is held in with a bank. A 3-in-1 account uses a trading platform as its front end with the bank and a demat account linked in the background. An investor can open all the 3 accounts with the same bank or broker using a single account opening form and common KYC. By integrating the 3 accounts, investors can carry out seamless online transaction across them. For example, funds can be easily transferred from the bank account to the trading account in the case of purchase of securities and back to the bank account whenever the securities are sold or redeemed. The 3-in-1 account features a login and password and does not enable operating the underlying bank account or demat account for any other purposes than settling traders completed on the trading account. The advantages of a 3-in-1 account are: firstly, it reduces manual paperwork involving checks, fund transfers, contract notes, account statements, order placement, and hassles of branch banking transactions. Then it is more convenient as investor does not need to physically coordinate with the bank, broker and depository participant. It enables efficient trading as the trading platform is linked through the broker's terminals to the live market, enabling access to real-time information on prices and market activity. Now we can see what is a power of attorney related with the capital market. Power of attorney is a voluntary delegation of power by the investor to a broker or depository participant to facilitate the delivery and receipt of shares and funds to settle the obligations arising out of the trade or transaction. In order to prevent fraudulent practices, SEBI has issued a detailed guidelines for execution of POA with regard to trading accounts. Brokers and DPs must ensure that the POA is created in accordance with the guidelines. Though POA is not mandatory for opening a trading account with a broker, it is required when an online 3-in-1 account is opened. This is because POA is needed for automatic debit from the client's bank account upon purchase of shares and automatic debit from the client's demat account upon sale of shares. Then we can see how the trade is executed in the exchange. To trade is to step into the stock market to buy or sell shares. Buyers and sellers converge at the stock markets to execute their trades using the electronic trading platform. Trades can be put through by brokers on their own behalf, that is proprietary trades, or on behalf of their client, that is client trades. Now we can see the trading system in the stock exchange. Stock exchange offer 2 types of trading system. One is open outcry and another one is online trading. Under the open outcry system, traders gather physically on trading floor and shout or signal their bid and offer prices. Online systems allow traders to trade electronically by connecting to the system without being physically located at the exchange. Trading in India at BSE, NSE and MSCI is carried out through online screen-based system. The fully automated computerized mode of trading on BSE is known as BOLT, that is BSE Online Trading, and NSE is called NEAT, National Exchange Automated Trading System, and on MSCI is called TWS, that is Trader Workstation. Buy and sell orders placed by investors, that is client orders, or transactions of trading members on their own account, that is proprietary traders, are routed to the trading system to be executed through electronic matching. The system supports an order-driven market and provides complete transparency of trading operations. Now we can see the orders as and when they are received are first time stamped and then immediately processed for potential match. If a match is not found, then the orders are stored in different books. Orders are stored in price time priority in various books in the sequence. That is the best price within price by time priority. Then to order matching rules we need to understand. The best buy order will match with the best sell order. An order may match partially with another order, resulting in multiple trades. For order matching, the best buy order is the one with the highest price and the best sell order is the one with the lowest price. This is because the computer views all buy orders available from the point of view of a seller and all sell orders from the point of view of the buyers in the market. So, of all buy orders available in the market at any point of time, a seller would obviously like to sell at the highest possible buy price that is offered. Hence, the best buy order is the order with the highest price and vice versa. Members can proactively enter orders in the system, which will be displayed in the system till the full quantity is matched by one or more of a counter orders and result into trades. Alternatively, members may be reactive and put in orders that match with the existing orders in the system. Orders lying unmatched in the system are passive orders, and orders that come into a match the existing orders are called active orders. Orders are always matched at the passive order price. This ensures that the earlier orders get priority over the orders that come in later. Now we can see the order conditions. A trading member can enter various types of orders depending upon his or her requirements. These conditions are broadly classified into two categories: time period conditions and price related conditions. Firstly, we need to understand the time conditions. That is, firstly we need to identify a day order. As the name suggests, it is an order which is valid for the day on which it is entered. If the order is not matched during the day, the order gets cancelled automatically at the end of the trading day. Then IOC. An immediate or cancel, that is IOC order, allows a trading member to buy or sell a security as soon as the order is released into the market. Failing which is, the order will be removed from the market. Partial match is possible for the order and the unmatched portion of the order is cancelled immediately. Now we can see the price conditions. Firstly, you need to understand limit price or order. An order that allows the price to be specified while entering the order into the system. Then market price or order. An order to buy or sell securities at the best price obtainable at the time of entering the order. Then stop loss price order. The one that allows the trading member to place an order which gets activated only when the market price of the relevant security reaches or crosses a threshold price. Until then, the order does not enter the market. A sell order in the stop loss book gets triggered when the last traded price in the normal market reaches or falls below the trigger price of the order. A buy order in the stop loss book gets triggered when the last traded price in the normal market reaches or exceeds the trigger price of the order. For example, if for stop loss buy order, the trigger is 93, the limit price is 95, and the market, the last traded price is 90. Then this order is released into the system once the market price reaches or exceeds 93. This order is added to the regular lot book with time of triggering as timestamp as limit order of 95. The sequence of trade execution is as follows. The first one is the first step is a placing of an order to buy or sell with the broker. Then routing of order by broker to trading system. Then display of order on the trading screen. Then matching of order electronically. Then confirmation of trade and generation of contract note. Trading in stock market has become less time consuming these days, as you can trade all by yourself without the assistance of a broker by means of online trading. Just like shopping for groceries online, you can buy and sell stocks online. You need not be an expert to begin online trading, as these trading platforms are user friendly and do not necessitate any special learning. Mobile trading apps have even made things easier for an investor or trader, as you can carry out any transactions in the stock market through your smartphone itself. You can trade from anywhere, anytime through the mobile trading app. Trading platforms provide all the necessary support and assistance by providing secured real-time access to trading, research reports, price analysis of stocks, market news, etc. You can buy or sell shares if you have a trading account and an internet connection. Not only that, you can trade in currency, commodity, etc. through one single trading platform. Platforms help you trade without any difficulty as these platforms enable high-speed trading. These platforms have revolutionized the way trading is done. You can simply download these to your system or mobile and can begin trading. Now we can just see the trading session. The pre-open session shall be for duration of 15 minutes, that is from 9 a.m. to 9:15 a.m. The pre-open session is comprised of order entry period and order matching period. The pre-open session shall comprise of two sessions. The first one is order entry period, then order matching period. After order matching period, there are buffer period to facilitate transition between pre-open and continuous session. Then order entry period. The order entry period shall be for duration of 8 minutes, during which order entry, modifications and cancellation shall be allowed. System driven random stoppage between 7th and 8th minute. Both the limit and market order will be allowed. Dissemination of indicative equilibrium price, indicative matchable quantity and indicative index values you can see. Then order matching period. Order matching period will start immediately after completion of order entry period. Then number of order addition, modification, cancellation shall be allowed. Opening price determination and trade confirmation can be also done. Then continuous trading session, that is from 9:15 a.m. to 3:30 p.m. Trades occur continuously as orders match at time or price priority. The continuous trading session will commence only after the pre-open session ends. The two trading sessions, continuous and call auction, that is pre-open sessions, will not run concurrently. The block deal trading session, that is for 35 minutes, will start with the commencement of the continuous session. Now we can see what is an online trading. You can place trade orders or cancel orders at your will from the comforts of your home. It allows you to make your own decision with regards to trading without any interference of the broker. You can buy shares or invest in IPO or buy mutual funds as well. Online trading can be done by simply opening a demat and trading account with any SEBI registered broker. Account opening can be done in a matter of 15 minutes. The documents required to open an account are PAN card, address proof, Aadhaar card, mobile number linked to Aadhaar, bank statement, cancelled checkleaf and passport photograph. Documents issued by trading members or brokers are first one is contract note. The trading member of the broker has to issue a contract note within 24 hours of the execution of trade. Digital contract notes are issued these days. You have to check the contract notes regularly and any discrepancy has to be taken up with the broker immediately. The broker also issues a quarterly statement of funds in digital formats. Benefits of online trading are: the first advantage of online trading is it is very simple one. It's a procedure where it's very simple and it is less expensive, quick and less time consuming, complete control, chance of errors are very less, monitor investment all time, access reports. Now first we need to know the simplicity. It enables a trader to have a hassle-free trading experience. Anyone can use these platforms. A specific skill is not required to carry out trading online. Then it is very less expensive. It is less expensive as compared to traditional mode of trading. Brokers also promote online trading as it reduces maintenance and other costs incurred by the broker. Then it is very quick and less time consuming. Trading can be done in a seamless manner and in less time. Before the advent of online technologies, trading was a cumbersome process as you had to visit the broker or call your broker for placing or cancelling trade orders. Now you can carry out trading even though a smartphone in the simplest way. Then complete control. It allows you have to complete control over your portfolio. You can place trade orders from anywhere, anytime. That is the kind of flexibility you get due to online trading. Then chances of errors are very less. In case of traditional offline trading, there were more chance of errors due to miscommunication between the traders and brokers. But in online trading, you can place trade orders or cancel without brokers' interference and hence can manage trade transaction by yourself. Then monitor investment at all times. You can monitor your own investments at any time. There are mobile trading apps that can be downloaded in your smartphone which help you stay in touch with the markets and also monitor your investment anytime and take proper strategic moves accordingly. The loss-making stocks can be removed and profit-making stocks can be added to your portfolio by observing the way the market moves. Then access to research reports. You can get access to top research recommendations, reports, analysis on stock price based on various charts. There are various brokerage websites through which you can have discussions with the research experts as well. You can take the best move with the help of financial advisors too. Then the safety measures that have to be taken in case of online trading are traders' orders should not be placed from shared PCs or cyber cafes. Always log out after carrying out trade in order to avoid any misuse of your account. Personal computers have to be protected against viruses by installing antivirus solution. Do not click on Remember Me option when you sign into your trading account from a different location. Investment in financial assets is offered by several brokers. You can choose that which suits your needs and demands after comparison of brokers on the basis of service, brokerage charges, etc. And online trading helps you trade or invest in the most secured way. It is very simple, easy and fast to trade online. Then we can see the terms related with the stock markets. First one is bull market, bullish. If you believe that the stock price are likely to go up, then you are said to be bullish on the stock price. From a broader perspective, if the stock market index is going up during a particular time period, then it is referred to as the bull market. Then bear market or bearish. If you believe that the stock price are likely to go down, then you are said to be bearish on the stock price. From a broader perspective, if the stock market index is going down during a particular time period, then it is referred to as bear market. Then trend. A term trend usually refers to the general market direction and is associated with strength. For example, if the market is declining fast, the trend is said to be bearish. If the market is trading flat with no movement, then the trend is said to be sideways. Then face value of a stock. Face value or a fee or par value of a stock indicates the fixed denomination of a share. The face value is important with regard to corporate action. Usually when dividends and stock split are announced, they are issued keeping the face value in perspective. For example, if the face value of Infosys is rupees 5, then if they announce an annual dividend of rupees 63, then it means the dividend paid is 1260% as dividend 63 divided by rupees 5. Then 52-week high or low. 52-week high is the highest point at which the stock has traded during the last 52 weeks, which also marks a year. And likewise, 52-week low marks the lowest point at which the stock has traded during the last 52 weeks. The 52-week high and low gives a sense of the range within which the stock has traded during the year. Many people believe that if a stock reaches 52-week high, then it indicates a bullish trend for the foreseeable future. Similarly, if a stock hits a 52-week low, some traders believe that it indicates a bearish trend for a foreseeable future. Then all-time high or low. This is similar to the 52-week high and low, with the only difference being all-time high price is the highest price the stock has ever traded from the time it has been listed. Similarly, the all-time low price is the lowest price at which the stock has ever traded from the time it has been listed. Then upper circuit and lower circuit. The exchange sets up a price band and which the stock can be traded in the market on a given trading day. The highest price the stock can reach on the day is the upper circuit limit, and the lowest price lowest price is the lower circuit limit. The limit for a stock is set 2%, 5%, 10% or 20% based on the exchange selection criteria. The exchanges places these restrictions to control excessive volatility when a stock reacts to a certain news related to the company. Long position. Long position or going long is simply a reference to the direction of your trade. For example, if you have bought or intend to buy Biocon shares, then you are said to be long on Biocon or planning to go long on Biocon respectively. If you have bought the Nifty index with an expectation that the index will trade higher, then essentially have a long position on Nifty. If you are long on a stock or an index, you are said to be bullish. Then Short position. Short selling stocks is a strategy used when you expect a security's price will decline. The traditional way to profit from stock trading is to buy low and sell high, but you do it in reverse order when you wish to sell short. To sell short, you sell shares of a security that you do not own, which you borrow from a broker. After you short a position via short sale, you eventually need to buy to cover to close the position, which means you buy back the shares later and return those shares to the broker from whom you borrowed the shares. You can make a profit from short selling if you buy back the shares at a lower price. Now, intraday position is a trading position you initiate with an expectation to square off the position within the same day. Then OHLC. OHLC stands for open, high, low and close. We will understand more about this in the different modules in the coming session. For now, open is the price at which the stock opens for the day. High is the highest price at which the stock trades during the day. Low is the lowest price at which the stock trades during the day. And the close is the closing price of the stock. For example, the OHLC of ACC on 17th June 2019 was 1486, 1511 and 1467 and 1499. Then the volume. Volumes and its impact on the stock price is an important concept that we will explore in greater detail in different modules like technical analysis like things. Volumes represents the total transactions both buy and sell put together for a particular stock on a particular day. For example, on 17th June 2014, the volume on ACC was 5,33,819 shares. Now we can see the different market segments. Market segment is a division within which a certain type of financial instrument is traded. Each financial instrument is characterized by its risk and reward parameters. The exchange operates in three main segments. First segment is capital market. Capital market segments offers a wide range of tradable securities such as equity, preference shares, warrants and exchange traded funds. Capital market segment has subsegments under which instruments are further classified. For example, common shares of companies are traded under the equity segment, abbreviated as EQ. So, if you were to buy or sell shares of a company, you are essentially operating in the capital market segment. Then, futures and options. Futures and options, generally referred to as equity derivative segment, is where one would trade leveraged products. We will explore the derivative markets in greater depth in related with the derivative modules. Then, the wholesale debt market. The wholesale debt market deals with the fixed income securities. Debt instruments include government securities, treasury bills, bonds issued by a public sector undertaking, corporate bonds, corporate debentures, etc. Now we can conclude this module. This module covered mainly stock market and its functions, stockbrokers and client acquisition, responsibilities of a stockbroker, trading system in the capital market, sequence of trade execution, and online trading. Thank you.